Well, for more on this, we have Larry Shover, Chief Investment Officer at SFG Alternatives, joining us now live from Chicago. Larry, hello to you. Thank you for joining us. We've just touched there on some of the drivers behind oil price action, moving towards 3-week lows. Let's just get your check on trade.
Well, the way I see it, short term, there's a lot of fear of the downside for output reasons. I do think, though, that we can see $55 a barrel by the end of the first quarter 2017, because I do believe output restraints will put a flame on the back of oil's fire. And right now, people are very skeptical of OPEC. There's a lot of headlines people are reading. The market's been very jittery, but let's keep this in mind. You know, the U.S. dollar has rallied, 4%? We have rates as high as they are, et cetera, and it seems like oil, up until the beginning of the year, really didn't care. So actually, it's taking a breather, and it is really subject to any kind of headlines that come out.
There's been the discussion that we're unlikely to see really a move towards stability in terms of the production cuts and policing and guidance around that until February. Does that mean this volatility is set to continue until then, Larry?
Yeah, I really believe that, and it's something I touched on last week. I mean, a lot of this is just headlines and people just reading between the lines. And you're right. I mean, we have tanker transport data that you can look at and guess, et cetera, but we don't get any credible data out until mid-February. Until that time, I do believe we're going to be in a narrow yet volatile trading range.
Well, let's just take a look at sort of some of the movements that we are seeing within this deal. We've had complying partner Russia's oil output declining, in fact, in January following the OPEC deal. We have a chart to show viewers, which, Larry, I'll guide you through. We have the gray bar for viewers is the daily output before OPEC cuts, and the light blue bar is output cut in first week of January from Russia. So that's highlighting that the complying partner Russia's oil output declined in January after that deal. So, I mean, this in itself, Larry, optimism coming through from Russia pertaining to their compliance with the move.
Yeah, I think there is a lot of optimism, and people might say, well, if that's the case, then why has oil retraced $4 a barrel since the beginning of the year? And it really goes back to oil just overshot. Oil just overlooked the rise in the dollar, the higher yields, things that really should put a heavy weight on oil's back, and it failed to do so. In fact, oil just looked the other way and kept going higher, up to $55 a barrel not too long ago. So, yeah, there is more stability, more confidence. We do know that the risk of all this is to the upside, and that's why the downside moves are so tragically slow and boring to watch.
But in the meantime, it does appear that that sort of emerging stockpile story is certainly proving to be somewhat troublesome, Larry. If we consider stockpiles versus OPEC output, U.S. crude stockpiles are forecast to gain while OPEC members cut. We have a chart on screen for viewers highlighting the pink bars there are indeed crude inventories, and the white line is OPEC daily output. So, I mean, in that respect, you kind of wonder if, if we've got OPEC members cutting, but U.S. stockpiles, in fact, gaining, it becomes really somewhat irrelevant almost.
Yeah, no, I agree with you on that point 100%, but I also believe that we're going to see demand response, and we're going to continue to see global activity, at least in the first half of 2017. And it wouldn't take much of that to take some of that output away, not to put us in a balanced market per se, but working towards one. And we also have to recognize that even if we do get to a balanced market, that doesn't necessarily mean it's a market that's going to take off. And that's why I still suggest we'll see maybe $4 to $5 higher by the end of this quarter.
So what else will you be watching in the commodity space? I mean, we've also seen coal rising in Europe, rising, in fact, to its highest since December amid the freeze there. What is your outlook on coal at present? How are you pricing this in?
Yeah, it's a great question because you look at like the bulk commodities, you also look at something like coal, and we're starting at such a high base in 2017, given the capitulation that went through 2016 and before. So we're starting the year at a high base, and I do think that prices will be somewhat stable up through the first half of this year, when we'll start to see a slight decline in industrial production numbers from China. I don't think China is going to have a hard landing by any stretch, but I do think their numbers will slow by the middle of this year. That said, I really do believe, except for something like nickel, I do believe that most bulk commodities will be lower at the end of this year than higher. I think agriculture, oil, and gold will all be higher at the end of 2017.
Certainly, we did see that uplift in commodity prices feeding through into China data. We'll be getting some comments on that shortly. But broadly, I mean, stocks worldwide rising off the back of a rally in commodities such as copper, such as silver, and also the dollar falling somewhat overnight. How is this feeding through into stock performance from your view, and how are you positioning yourself sort of for the future expectations?
Well, you know, how I'm positioning myself is similar to last year, just a little bit more heavily weighted towards the Eurozone and towards Japan. Both of those countries I like a lot. When it comes to Japan, their corporate balance sheets aren't using leverage, so a declining Japanese yen, which is also my call, could actually benefit the stock market. I think Europe, the Eurozone in general, is a good play on value, and I do believe value is where you need to be and just continue to get out of growth stocks. U.S. is okay. I just think you're taking too much risk for the amount of upside that remains in the United States stock market. A lot of unknowns, and yeah, I could be dead wrong, but I think there's a better bet for your money going to the Eurozone and overweighting Japan compared to the U.S.
Larry, we will need to leave it there. Thank you so much for your comments today.
Thank you.